Hi everyone, I'm Tate Chicolo, and today my group and I are going to be talking about Chapter 9, which is life and health insurance. Our team consists of Xavier, myself, Jalen, and Chelsea. Some key insurance terms I'm going to talk about before we get into things are premium, which is the amount consumers pay to purchase and continue a policy. It's basically like a subscription service where you pay a certain amount each month and you still have to pay regardless of if you've used your insurance or not that month. The benefit period is the time during which an insurance policyholder or their dependents may file and receive payment for a covered event. And this is usually in place so insurers can control risk. Deductible is a flat dollar amount consumers pay before their insurance starts. In the example, if your deductible is $2,000, you have to pay that before your insurer pays for the rest. Co-insurance is a certain percent that the consumer pays each benefit period after they paid for the deductible. The most common are 80/20 and 70/30, where you pay your deductible and then the insurance will either pay 80% or 70% of your bill. Copayment is the amount a consumer pays to the health provider at the time services are rendered. These amounts are determined by your insurer, and depending on the plan, you may not need to pay copay at all. Importance of insurance. So what is an insurance policy? An insurance policy is an agreement between a policyholder and an insurer where the policyholder pays a premium in exchange for coverage for loss specified in the contract. For health and life insurance, they're both extremely important. Health insurance helps to protect your family from calamitous medical bills, and life insurance protects in the event of your death. Both are a key essentials to planning your finances and controlling them for both before and after you die. And without insurance, a small illness, mishap, or anything can lead to financial catastrophe for you and your family. High cost of healthcare. If we look at the graph on the right, the United States spends $10,586 per person on healthcare expenditures, which I thought was a very interesting stat considering the US is the only country that does not have universal healthcare that is developed. So the only developed country without it. And some of the reasons are like uncertainty and cost of creating new drugs. It's a three-phase process where companies pour millions of dollars and years of time into research and development. And then those prices are reflected on the customers and patients when the drug is eventually approved by the FDA. Monopoly prices. There are many places where there is not a lot of competition. So hospitals can charge whatever they want and not have to worry about it. Physician-induced demand is when a physician gives a patient something that may not be in their best interest, but it is worth the most. So the hospital, the physicians will be making more money and the drug is going to cost more. Some of the reasons for medical expenditures increasing can be attributed to price, which is because of new technology, machines like MRIs and other ones like that are extremely expensive. Also, nurses, doctors are demanding more money, and resources in general are harder to come by. Quantity demanded due to a rising aging population. There are a lot more people that need medical care. And in addition, a richer population, the people that have more money want to be healthy, so they're fine with putting more money into healthcare. Technology overuse as well. Many times people that are insured want the best treatment they can possibly have, but it isn't necessarily the most cost efficient. And on the bottom here, I have, in order to prevent these prices from continually soaring, medical care and insurance must become more efficient and economize. Kind of like I just touched upon, like cost benefit analysis and cost efficient analysis, where doctors and people can decide if one treatment is efficient or not, where you don't have to spend way more than you should. So here I just have some graphs and tables to show the rates at like the emergency rooms. So the average ER visit is $3,100. And if you look on the right in these two tables, the emergency room rates for common conditions and common services are shown. And they range from anywhere from $260 to $10,000. If you're not insured, a $10,000 bill for a broken arm could put your family in financial ruin. That's why health insurance is so important, because it's there to prevent financial ruin. Even if something doesn't happen, you have it just in case. However, As we touched on a couple slides before, US spends the most, but it does not have universal health insurance. So that leaves 28 million people not insured, which is 8.6% of the population. And this is due to the fact that some people can't afford insurance, or some people have a recent change in lifestyle, such as getting fired from their job where they're provided insurance through some employee sponsored plan. And it becomes difficult for them to then afford insurance without a job. And without insurance, an accident can financially ruin a person or family. Many uninsured people just don't go to the hospital for minor injuries or minor symptoms of something, and they're less likely to receive a diagnosis in early stages of illness or injury because they're afraid of, if they go because they have a small problem, that they'll incur high fees, even though that the best option is to go to the hospital. Programs were enacted, such as the Affordable Care Act, to try and make healthcare more affordable for people who could not obtain it. It was enacted in 2010 by the Obama administration, excuse me, and it was designed to reduce the cost of health insurance for those who qualified. It includes tax credits, cost share reductions, and basically tax credits are advanced payments by the government that gives assistance. And if you've taken more advanced payments than you're eligible for, you may have to pay back during your income tax return. And cost share reduction is just a discount, lowers the amount you have to pay for deductibles, co-insurance, co-payments, and it usually only applies to silver plans on the marketplace.
Hi, my name is Jalen, and now I'll be covering life insurance needs and designing a life insurance program. To start, most may wonder if they actually need life insurance or if it'll even benefit them. Life insurance allows you to eliminate or substantially reduce the financial consequences of death for your dependents. So this means that you can provide more stability for your family members, spouses, children, anyone who really relies on you or depends on you once you pass, and that income or that amount of money or assets you possess. So it going away would be a detriment to them. Life insurance can also be a potential business asset and something you can use, going down the line for other as another tool. So one of the main factors of life insurance is the risk pooling. It is how those who buy into life insurance share their financial risks. In a sense, those who are looking to purchase life insurance, pay a premium, which is the amount that they are charged to buy into the pool. And when someone from that pool passes away, their dependents are able to take some of the funds from the pool that they have accumulated with everyone else that has also bought into that specific group. Uh, your premium, which is how much you pay for the pool, is based on your life expectancy, and that is determined and calculated by the number of statisticians and people hired by life insurance companies, and based on your um, health, your eating habits, exercise habits, basically your physical characteristics, but also your lifestyle choices. For example, smokers often get a higher premium because they have a shorter life expectancy and are more likely to die at a younger age than non-smokers. So they're charged more at a higher rate than a non-smoker would be. The face amount of the policy is how much is provided by the life insurance company at the time of death. So once someone, the holder of the policy, has passed away, the face value of the policy is then paid out to their dependents. And sometimes these life insurance policies get sold to other businesses or companies as asset at a discount. The original policy holder can sell the life insurance to recoup the face value a little bit early. Obviously, like I said, at some sort of discount, and the new business partner will then be able to hold that life insurance. And when the person does eventually pass away, they're then paid the you know face value at a later date. So, how do you know when you should be taking out a life insurance policy? It really depends on your specific marital and your family situations and statuses, but there are some pretty clear groups of people who could really benefit from it. So, you really should have life insurance if you have any children, if you are married with an unemployed spouse, if you own a business. As once you pass away, a life insurance policy can pay off business debt. And if the value of your estate is over the estate tax-free transfer threshold, as life insurance can be an effective tool for passing on estate assets without paying too many taxes. Anyone who should also consider is those who are married but they are unemployed, so that maybe taking out life insurance for their spouse, or anyone who their lifestyle might suffer if them or their spouse passed away. If you have young children and they're not going to be self-sufficient for a while, or even if you're retired, would your spouse be able to live on your savings or social security if you die? If that's not enough, you should consider taking out a life insurance policy. Those who probably wouldn't benefit the most from having life insurance are anyone who's single, no dependents. You and your spouse are both married, so you should be pretty fine with income if one of them were to pass away. So once you determine that you are looking to take out a life insurance policy, you're going to then need to calculate how much life insurance you're going to need. It's really relative to your own personal goals and lifestyle, and you really base it off of what your priorities are going forward. What you need to cover for, what you need to plan for, how much do you make, and you start by calculating your net worth. You do this because your net worth really is a determinant of how much wealth you have to pass on. If you have a higher net worth, you have more wealth and assets to leave to your dependents, and you'll need less life insurance. And planning out your life insurance, you always need to take into account inflation and taxes on future earnings to more accurately prepare. There are two approaches to calculating life insurance: the earnings multiple approach and the needs approach, and we'll go into those right now. So many financial planners suggest that your life insurance policy cover about 5 to 15 years of your annual gross income. The earnings multiple approach was developed in order to accurately calculate this for determining your life insurance policy. And this approach is really looking to replace a stream of income with a lump sum settlement, and it doesn't really take into account any of your savings, financial well-being, investment strategy. It's really just sort of one size fits all approach, and is similar to the concept of finding the present value of an annuity. The process for this approach involves just multiplying the present annual gross income by the appropriate earnings multiple, and that gives you how much your life insurance should shoot for. The table on the slide depicts a number of combinations for years that you want your lost earnings stream to replace, and the potential assumed settlements for after tax and after inflation return. Now, an example of the earnings multiple approach being put into use was given through the Cohen's family scenario. In this circumstance, the husband makes $80,000 a year, and his wife believes she can get a 5% return on their invested settlement once he passes away. They have two young kids who are at least 20 years away till being self-sufficient. So they want to make sure that this life insurance policy covers any need to take care of those kids. It'll be a surviving family of three people, which means a 22% decrease in living expenses after the husband's death. You then discount his annual income of $80,000 by 78%, which gives you $62,400. One of the sort of simple ways to use these numbers is then to just you can put this right into a financial calculator, and enter 20 for the years, 5 for the interest, 62,400 for the payment, and zero for your future value to solve for $777,642 of what you would shoot for in a life insurance policy. The next approach is called the needs approach, and this one accounts for the different needs versus the average family, and is more customized than the one size fits all method of the earnings multiple approach. Some of the different needs that might be considered depending on your own family situations are dependency needs, debt elimination, immediate needs such as funeral funds, final health costs, spousal life income, educational expenses for your children, or even having some extra money for your retirement needs. So this approach really goes into breaking down what exactly each one of these different categories are required, and then sort of saving up and planning based on that. It's very important to remember when using the needs approach that you must calculate the dollar amount for every category. That being if it's debt, spousal income, retirement, education. Then that's really every single specific instance of what you might need is calculated to its own extent, and you also have to keep in mind the time value of money and how far away your different goals or priorities might be. If you want to save for your children's college or for different things going on in the future, how might that value of money change between now and then. Also of note, 30% of US households, up from 22% several years ago, don't have a life insurance policy. And this includes 11 million families with children under 18. Definitely a bracket that one would think should really consider life insurance and might be a benefit to them. Now that you've learned about what life insurance does and provides, and you can now figure out what kind of insurance works best for you.
Good evening, everyone. My name is Xavier Hunter, and today I'll be talking about the different types of insurances as well as their provisions. Here we have the four different types as you see here on the screen, as well as a chart that differentiates each of the types. All right, so for term life insurance, I just want to define a couple terms. So your coverage period is the time frame in which your insurance policy is effective. The animal benefit is the total premium or money payout for 1 year of coverage. Death benefit is the payment or payout to the beneficiary of a life insurance, annuity, policy, or pension. And lastly, the cash value is the portion of the policy that earns interest and is available to be withdrawn in case of an emergency. And so for here, you have your stats for term life insurance and a nice chart showing you what payments or premiums would be in January of 2022. Next, we have whole life insurance. Whole life insurance, your coverage period is permanent protection. Annual income is fixed, so you're only paying a fixed amount at the beginning of the year. Death benefit is fixed amount as well. And also the cash value will be fixed, and your investments grow on a tax deferred basis while the policy is in use. And here we have big time policy issuers, Northwestern Mutual, all household names, as well as State Farm here. For universal life insurance, our coverage period is permanent. The annual premium is flexible according to the policyholder's current financial needs. Death benefit is flexible as well. You just need to show proof of insurability. And the cash value depends on your payments, as well as the investment yields. And this is just an infographic showing you what universal life insurance looks like. And this is what happens in the real world. Next, we have variable life insurance. For your coverage period, it's permanent. Your annual premium is fixed or flexible. Fixed or flexible. For the death benefit, it's flexible, and that's contingent upon the performance or yields of your mutual funds. And the cash value is also contingent upon the yields of your mutual funds. For here, in the infographic over here, you see what the global variable life insurance market looks like for the next couple of years. And I know it seems like a lot of information here, but basically your clauses are to assign risk associated with the insurance services. So it's shifting the risk from the client. So it's there to protect you. And so you have the contract clauses, which is the provisions that appear on the insurance policy or contract. The beneficiary provision, as well as the coverage grace period. These are all things that are put in these contracts to make sure that you're protecting yourself, right? So for instance, the coverage grace period, it gives you extension, usually 30 days, to make premium payments without canceling your coverage. So it's all there to shift the risk from the insurance company. No, excuse me. It's there to shift the risk from you to more so the insurance company. Loan clause as well allows you to borrow against the cash value of the policy. You have the non-forfeiture clause, which defines the choices available to policymakers who miss premium payments. The policy reinstatement clause deals with conditions necessary to restore a lapsed policy, as well as the change of policy clause. So it allows you to change the form of your policy. And next, we have a suicide clause, which states the insurance company won't pay for the suicide deaths that occurred within 2 years of the contract. And other clauses such as the payment premium clause and the incontestability clause, as you can see the definitions here. And riders, we go into the riders next. So basically, the purpose of riders is to add benefit to the original clause, just making sure that you have more coverage. You have the accidental death benefit, which increases the death benefit, um, sometimes doubling or tripling it. You have the guaranteed insurability rider, gives you the right to increase the insurance protection in future without a medical exam. Also have the COLA, so the cost of living adjustment, as well as the living benefits rider. Next, we have the settlement and payout options, which is just another alternative way to pay out the beneficiary. You have a lump sum, which you pay the entire death benefit tax free, or you have the interest only, which you receive the death benefit immediately. However, it's left on deposit with the insurance company for a specific length of time. All right, next we have the insurance only, which basically receiving the death benefit immediately, but during a specific length of time. You have installment payments, which you pay a single lump sum through a series of payments, usually specified start and end dates, payment frequency, and how much you want in each payment. And lastly, you have the life annuity, which is your beneficiary is paid for life. So it could be straight out, which is like a monthly benefit, or in periods. So you get the benefit for X number of years. So if you're looking for insurance, where do you start? Credibility is a great place to start. Is your salesperson a chartered licensed underwriter? Do they know about taxation, business law? Are they reputable? Do people trust them? These are all great things to look for when you're looking for insurance, right? You want to look for credibility, making sure that whoever is covering you knows what they're doing and they're not going to um, manipulate you or take advantage of you. Next, you want to look at comparing costs, right? We want to look at different policies and which one works for us. So in the two infographics here, you can see an example of the traditional cost as well as the interest adjusted net cost method used. So what you want to do for the traditional net cost, correction, the traditional net cost is to add the premiums over a stated period, usually about 10 to 20 years, subtract that from some of the dividends over the same period. The policy's cash value at the end of the stated period is subtracted from this amount. And the final value is divided by the number of the years, stated period, and presented as a total net cost for the same level of coverage. I want to caveat and say that this does not involve the time value of money. So if your salesperson is using this method, run. They don't know what they're doing. Next, the interest adjusted net cost method does take into account the time value of money. So if they're using this, they have a little bit more sense to them. So you can take your chance. We also have websites here if you are looking to get different quotes. And lastly, you want to consider everything. Consider your age, where you live, your assets.
There are many ways to get health insurance. The first way is through your employer. The second way is through the Marketplace, which is a consumer-friendly website that allows consumers to compare private plans to find one that fits best for them. And then you have federal programs. So Medicare, which is for those age 65 and older, younger people with disabilities who've been receiving Social Security disability benefits for 24 months, and those with end-stage renal failure or ALS. And then Medicaid, which is for low-income individuals, families and children, pregnant women, elderly, and people with disabilities. The ACA has 10 essential benefits. All of them are listed below here. The biggest thing to know is that all pediatric services are covered, which includes oral and vision care, but oral and vision care are not considered an essential health benefit for adults, and so they don't need to be covered. The ACA has 4 major provisions. Under the first one, providing new consumer protections. The biggest one is that companies can't deny coverage for an individual with a pre-existing condition. What that is if you have a condition prior to the start of your insurance policy. The only exception to that is grandfathered plans, and those are plans bought on or before March 23rd, 2010 by either insurance companies, brokers, or agencies. And so they don't have to have the benefits of the ACA. The good thing, though, is that if they prove to be a significant detriment to their policyholders, then they can lose their grandfather status. Under improving quality and lowering costs, they've helped to phase out the drug donut hole and coverage gap. And so what that is it occurs over here in phase 3. What happens here is that the beneficiary has to pay a total percent on the total cost of their drug. And so in the past, it would be upwards of 70%, and it was putting the beneficiaries in a financially vulnerable position. So what the ACA has done is they put a cap, which is 25%. Obviously, it's still pretty big, but it's nothing to what it used to be. Under increasing access to affordable care, children will be allowed to stay on their parents' plans until the age of 26. And holding insurance companies responsible, they have this 80-20 rule, which says that 80% of all premium dollars collected must be spent on healthcare services and quality improvements. And if not, then consumers are entitled to a rebate on part of the premium that they paid. You have 2 types of private healthcare plans. You have fee-for-service, which will either pay the provider directly or reimburse you after you've made a claim. And then managed healthcare plans. Most expenses are covered, but there's a limit on the service providers that you can choose. You have the health maintenance organization and the preferred provider organization, which are 2 types of managed care plans. Under the HMO, it's for a particular geographic or service area, and you have a comprehensive set of services as long as it's in network. And if you decide to go out of network, unless it's an emergency, the total cost has to be paid by you. And then you have referrals. So let's say you have a big mole on your head and you want to make an appointment with a dermatologist. You can't just do that. You would first have to go to your PCP, which is your primary care physician, and they would have to give you a referral for you to be able to make that appointment. The only exception to that is OBGYNs. And then for PPOs, it's more widespread, so it allows for more flexibility and you don't need any referrals. So if you have that mole, you can go ahead and make that appointment with your dermatologist. These are examples of PPO and HMO insurance cards, and the biggest difference here is pricing, which you can see. Medicare has 3 main parts to it. You have Part A, which is hospital insurance, Part B, which is your medical insurance. Those 2 together are considered original Medicare. And then you have Part D, which covers outpatient prescription drugs. What Part C is it's called Medicare Advantage, and that allows private insurance companies to give all of the benefits of Part A, B, and usually D, but it's just through the private insurance company. Medicaid is a joint federal and state program, so the benefits do vary from state to state. If you qualify for both Medicaid and Medicare, then you're considered dually eligible, but Medicaid is extremely limited in scope. There are many different ways to control your health care costs, and they're all listed over here. The biggest thing to remember is that you must be able to qualify for one of these things. So it's very, very important to read the fine print, especially when it comes to healthcare. So what you should look for in a plan, you should look for who's covered, the terms of the payment, and any exclusion. The biggest thing to remember is that deductibles and premiums have an inverse relationship. So the lower your deductible, the higher your premium will be, because the company takes on more of a risk by paying more in the event you make a claim. So that's important to keep in mind. Disability insurance is an insurance policy that provides income to those who can't work because of a disability. Ideally, everyone should get it, especially if you rely on a job for income and have dependents, but most people don't have it because it is expensive and rates depend on the class first of your job. And these are ways you can get it. So you can get it through your employer, Social Security, workers' compensation, and obviously you can get it on your own. But again, it's just important to make sure that you qualify for these things. So read that fine print. Some features that make sense is the definition of disability. So for most policies, it's if a person can't perform the duties of their own occupation or for any occupation for which they're reasonably suited. But if you would like more cushion, you can opt in for the accommodation benefit, which says that you are eligible for benefits if you can't perform the duties of your own occupation for the first 2 years, and then thereafter any occupation for which is reasonably suited. Then you have the waiting period, which is the period after your disability where no benefits occur. That can range anywhere from 30 days to 2 years. The longer that period, the less expensive your policy will be. And then the non-cancelable feature, which is something that you should insist on because it protects you in case of your risk for disability increases. And the long-term care insurance, that pays and covers the cost of care for those with chronic medical conditions, disabilities, and disorders such as Alzheimer's. It requires that the insured cannot perform at least 2 of the 6 activities of daily living or ADLs to get the benefits. So bathing, dressing, eating, transferring, which is kind of like walking, toileting, incontinence, the ability to control your bladder and bowel movements. So things to consider is the type of care covered, the benefit period, the waiting period, inflation adjustment, and the waiver of premium, which says that when you're claim eligible, you no longer need to pay premiums.